And first off, any questions about anything, excuse me, that we looked at this morning? Nice, Nicole, that's good, I like it. It's the worst, they can't play games today. Can't watch videos. Okay. Okay. So just reference the question that was asked about the link. I'll mention that now that everybody or almost everybody is here. So yeah, we do use the same link pretty much all the way through the classes. I think at some point I'll have to add a new link in there. We'll change it up, but you'll get plenty of notice when that happens. There's still a lot of people not back from lunch. Maybe 45 minutes is not enough time, but I'm not changing it. That's quite all right, thanks. Okay. Yeah, thanks. That's a good question. Any other questions about anything we looked at this morning? Okay, perfect. So then, this actually ties into something that happened already in class this morning that I was super happy with. And my third comment here, don't rely on me alone. Okay, I don't want to say that I'm not trustworthy. I'm sure that I'm at least partially trustworthy, but I want to make sure that as we're working through the course from time to time, you're reading other stuff. There is lots of other stuff out there, and it's useful to hear a variety of sort of voices, because when you get to the exam, it's not going to be my voice on the exam. It's going to be, I talked about that this morning, some other set of financial planners. So those folks are going to have slightly different ways of looking at things. They might use some of the language differently. So in that regard, I think it's good just to be reading in general. And this is a concern that I have a little bit with this course, although I'm not willing to make the sacrifice to change this. But you have the videos are me, the classes are me, the questions are me, and the textbook is me. I am the primary person who produces all of that stuff. There's a small amount of textbook stuff written by other people, but really negligible. And then you do get exposure to some other graders as you work through, so that's good. You get a different voice that way. And some of those graders have been graders for FB Canada in the past, which I like. But read lawyers, read accountants, read other financial advisors. There's lots of good stuff out there. If you're looking for just a source of content to read, if you're looking for other stuff, one of the easy things you can do is follow me on social media. Not me personally, that's lame. There's nothing good on my Facebook, but yeah, thanks, Paul, appreciate it. And they work well if you're in the car a lot, which we are a lot less now, right? But anyways, yeah, you can follow me on LinkedIn. So I'm Jason Watts, CLU on LinkedIn, or Jason Watt BCC on Twitter, or Business Career College Corp on Facebook. And they all get the same thing. Okay, oh, that's good. Yeah, they all get the same thing. They get 3 articles per day, and all the same articles. There's no point in following more than one. Okay, so 3 articles per day, and they're all financial advice or financial planning related. Some of them have group benefit stuff in them, or some of them are about regulation, but it's all financial planning stuff. You won't find me posting like what I ate for lunch or anything like that. So that's it. And then, yeah, I have my podcast, which I mentioned on here. So if you're a podcast person, I've got some podcasts. This one is mine. Okay. Oh, I don't know, Steve. I find that's a little wacky sometimes with Zoom, and I don't know how to fix it. I think if you okay, good. How did you do it? Maximize, minimize? Turn it off, turn it on?
Yeah, I double clicked the screen, so that brought it out of full screen.
Yeah.
And then I just double clicked again, and it just made it 1.
Okay, perfect. Yeah.
It shows your whole presentation, and then also has a full bar on the side. It's just handy.
I know what you're talking about, but I don't run mine like that. I run mine on my second monitor. Yeah. Okay. And by the way, if you're not running two monitors, it makes life so much easier. Um, oh, I don't know why that is, Paul. That's interesting. Okay. Huh. I didn't notice that. I listened to them, but I didn't notice that. So yeah, anyways, CE Drive, that's me interviewing mostly financial advisors, a few other odds and ends, but mostly financial advisors about technical issues. Pavel Berminsky, who does Snap Projections, runs this Building Your Financial Advisory Practice podcast. The title's very long, but it's all interviews with people that have operating financial practices in Canada. It's pretty good. It's around an hour long. I was a guest on episode 25 of Building Your Financial Advisory Practice, but mostly it's advisors on there. And what is probably my favorite financial advice podcast, at least right now, is Kitsis and Carl. I didn't particularly enjoy the last episode, but every other one I've listened to has been excellent. I've listened to all of them, and they've all been excellent, except for that last one, which I thought was a little weak, but I understand why. But anyways, they do client communications, and there's so many good client communications things. And that's what I wanted to comment on, actually, is it wasn't client communications, but Grant, you mentioned your building your financial advisory practice, Cam, just down at the bottom there, or CE Drive. I don't know which one we did first, but they're all named in there. Yeah, debt free. Sorry, the Kits and Carl is it's so good. They do all this client communication stuff. But yeah, Grant mentioned. Sorry, this is what I wanted to give Grant credit for, and I failed. Is when I said other opinions are useful, well, that's yeah, exactly. So when Grant mentions that spin method, for example, that is a great example of somebody else presenting well-earned subject matter. That's perfect. So that's where I like the chat box, and I like when people share stuff like that. It's good for all of us to see different ways of doing things. And it's also where in class, I don't mind if you disagree with me. Okay, if we're going through a concept and you say, that's not how it works in my experience, perfect. I'm not going to get upset at those conversations. Okay, there's some utility in that. And the ability to do that will help you on the exam. Okay, if you can show, this is how I perceive something, this is how Jason perceives something, and where's the differences and where are the commonalities, that's a very useful skill on the exam. So don't be shy about those kinds of things. Hey, I can deal with it. I promise whatever you're disagreeing with me on, I won't take it too personally. Okay. Oh, I know Neil Rackham. Okay, I don't know why I didn't know that. All right. Okay, so Kitsis and Carl, it's all client communications. And debt free in 30, it's really good because remember I said there's this whole credit and debt section now in the course. And what I find is now I know some of you do some mortgage work, but I find even there it's pretty focused on one particular area. So this is a way to fill a gap for many of us. And that is to get better at financial management, the sort of fundamental financial management stuff that is now heavily examinable. Okay, and it's genuinely a good podcast. It's just a lot of good foundational money management stuff. And it's not caught up in the FIRE movement or whatever. The guy who hosts it is actually an insolvency trustee, and he covers just a good range of topics. So have a look at that one. As far as sort of direct applicability to the exam, that's probably the one that's most applicable to the exam. Okay, just popping back up here, I want to say that, I don't know how we got sidetracked on podcasts, but supplemental study, you need to be doing some of this. You need to be looking for answers to your questions in, just Google. Really, today you can Google all kinds of stuff and find law firms, accountants, other financial advisors who have written good posts and have good opinions to share. If you're not subscribing to Investment Executive and Advisor.ca, I strongly recommend it. This is an easy way to fill that 20 or 30 minutes a day. Both are free. Okay, now, if you follow my social media, you'll get whatever the financial planning articles there anyways, but it's still, I think, worth following. Kitces.com, subscribe here. It's also free. And he's American, so you have to watch this a little bit, but the financial planning content that he posts there is excellent. There's a lot of really good research about how financial planning practices run, lots of good behavioral finance stuff on there. I really am a huge fan. A lot of people are of Michael Kitces. He's not some hidden gem. He's somebody that I think every serious sort of financial planning person follows. He's just good, sort of pure thinking about financial planning. I mentioned Forum. If you happen to be an Advocates member, I like Forum magazine. I find it does a good job with having articles that cover a range of topics. So I'll give props to Advocates' Forum magazine. Okay. Any questions there? All right, perfect. Okay, now I want to talk about financial planning process in general here. And I think that a lot of you probably recognize already what I have going on here. So what's the deal with my left-hand picture? How is that relevant to the financial planning process? Okay, it's kind of it, right, Paul? So I'm going for the crystal ball here, Grant. I don't know, but maybe there is some of that. And that's what I'm shooting for here, Tricia. And I think this is what happens. I think this is the expectation people have when they read their financial plan. So if I just sort of produce a financial planning document and I hand it over to a client, I think clients expect that that's our sort of attempt to look into the future. But it's not what you're doing with a financial plan, is it? So I don't know how exactly you package this for your clients, but I like the roadmap. I know I've heard others. I've heard people talk about a blueprint for a house or whatever else. But I'm a fan of this concept where we say, okay, client, here's what it actually is. You're at point A and you want to get to point B. And there are many different paths that we can take. Now, I'm going to make an effort here to map out the most direct route for you. So we're going to try and figure out, and the financial plan should be that most direct route. But if that's all it was, nobody would actually need a financial plan. It's actually not that useful if everything just goes according to plan. Because really, why do I need a plan if I kind of know everything that's going to happen? What we're doing with the financial plan is we say, you know what, along the way, there are going to be things that happen that throw us off the route. And some of those will be good things and some of those will be bad things, but we have to be prepared that we're going to have these, that's exactly it, these unplanned events, Greg. And we don't know, right? Now, we can sort of speculate about this. So we can talk about, if we're looking at the bad stuff, we can look at job loss, or we can look at marital breakdown. We talked about that this morning. Or we can talk about somebody gets sick, or we can talk about a car crash, or we can talk about a pandemic. Anybody have this in their financial plan? okay? Whatever it is, right? Okay, Craig, you're going to be a pro at that, right? So on the good side, we also can think about stuff that happens on the good side. It's not all bad stuff that our financial plan should be concerned with. We might talk about what happens when that baby shows up, or twins, as the case may be, right? We can talk about what happens if you get a promotion, maybe have to move as a result. Perfect. We can talk about receiving an inheritance. Look at that, Stephen. Sorry, Philip, right? I apologize. I don't have my list of names handy. But okay. We could talk about winning the lottery. I don't know if I'm a fan of putting that in my financial plan, but what should happen then is the financial plan says, look, when one of these things happen, here is our set of responses. Okay. So if something happens, good or bad, here are our responses. So we might talk about some contingency planning. We might talk about decision making. We have our risk management in place. Okay. All those tools are there for us. And it's not that the financial plan is necessarily going to have every possible good thing and every possible bad thing in it. What I actually am a big fan of is writing a financial plan that contemplates sort of two bad and one good things, and you try and make it something that's representative for that person. So if I'm dealing with a 35-year-old tradesperson, for example, I might say, what if you have a serious long-term disability? Okay. And Bonnie, for my 35-year-old tradesperson, a serious long-term disability is a very real risk, isn't it? That's where I want to make sure that I have Bonnie cut her teeth in the trades, right? So make sure that I have a good handle on what's relevant for this person. Okay, so think about some way to get my client thinking about risk management. Because yeah, I'm not going to predict a pandemic. Nobody outside, I guess, no normal person predicted this whole situation, right? But if I had a good financial plan in place that set up an emergency fund and talked about a reduction in cash flow and talked about how to deal with my investments in a downturn, that person is better protected than most for an event like this. Is that fair? Do we find this, those of you that have done financial plans for clients, as a matter of course? Do you find your clients leaning on their financial plans right now? Or has this gone out the window? I hope so, Grant. I hope so. It really, if it's working, I think it validates the whole thing. If it's not working, then we want to look at, is the process wrong? Is the something in how we presented it wrong? Yeah. Okay. I think pretty quiet is good, Paul. I think that's good. Okay. I knew what you meant. Yeah. Okay. Yeah, I mean, and we're sort of at the bottom end of Monte Carlo, right? Okay. For those that don't know Monte Carlo, what Monte Carlo does, it takes like a single projection and adds some uncertainty to it and runs, what, 1 million? Do you do 1 million for your, I can't remember what the Navi Plan one is, but 1 million different versions of that outcome. And it sort of shows a range of outcomes. Was that all it is 500? That's boring. 1 million is way more interesting. All right. Oh, nice. Okay. But it doesn't really matter. It's once you get to a significantly large number, there's no difference. Okay. Perfect. Okay. So I just want to reinforce that when we present the plan, it's not a one and done thing. It's an ongoing process. It lives and breathes with you, and it's designed to help us adjust to these events. Okay, I think we covered that off actually already. I think I'm good with that. All right, we talked about that already. We did our guidelines. We covered that. We're good. Okay, perfect. Not too bad. Only 25 minutes over for our morning. That's okay for me. Are there any questions about anything we looked at in the morning session? Okay, so let's move on to the afternoon session. And here we're going to look at economics. Now, I just want to give my little precursor to this because it's very easy to get caught up in this. It's really, and I hate to say it this way, it's a fairly low priority item, okay? There's a little bit of foundational stuff we need here. This is good for some client conversations, especially in today's environment. But we are not economists. And really, when we get into real life interplay, anybody have an economics background? So I know a lot of people here will get stuck on fiscal and monetary policy. Okay, so Andrew, you know this, right? You learn your econ, whatever, 101, 301, 401 stuff. And as you get deeper into it, you realize how much the reality, the moving parts mean that the theory you learned in your 101 course doesn't necessarily hold up. Is that a fair comment? I think economics is a great example of one of those fields where the more you learn, the more you realize how much you don't know. Or do you think I'm mischaracterizing that, Andrew? Yeah, and I think so this is the problem here is we sort of do a very, very rudimentary version of this fiscal and monetary policy. But the fact is, okay, perfect, Stephen. That's good. That's what I'm shooting for. The real life interplay between fiscal and monetary policy is very challenging to track and just doesn't necessarily have the intended consequences in all cases. And we can point to our last prime minister. So our last prime minister was an economist by training. And there's a bunch of stuff I'm going to teach you in this chapter that he directly, like immediately did not believe was correct. Okay. And he definitely knows more about economics than I do. So I have to teach you sort of these building blocks, but you'll find that a lot of good economists don't acknowledge things the same way that they show up here. All right. That being said, there's still some utility to learning these concepts. Now, the other comment I have here is very low likelihood of this stuff being directly examined. Okay. They might sneak into a question here and there, but the chances of having a pure sort of monetary policy question is incredibly low. So we need to hammer this out. We need to get it done because it does give us some tools for later on in the course, but we're not really learning this so that you're going to go out and deal with econ questions. Okay, I hope that doesn't take the wind out of our sails. I just want to have realistic expectations about what we want to get out of this chapter. Okay, so we're going to look at just some fundamental ideas. We'll look at the business cycle, which is a fundamental idea. We'll talk about leading, coincident, and lagging indicators, which is quite a confusing concept. we'll look at money, which is actually pretty important and ripped from today's headlines topic in a lot of ways. We'll talk about StatsCan, and we'll wrap it up at the end, okay? And I'm happy if people have questions about what's happening today, like economics questions, but my capacity to answer some of these questions is going to be limited. We are really in a very unusual time. And what's happening today is going to break some econ models. Okay, so just thinking about the table of contents again, I just want to point out, so a really good question came up this morning. I think, Paul, it was you that asked it, about when people kind of fall off the radar or lose track of having to get the homework done or just stop attending class. And this is going to be tough. There's going to be a little bit of management here on your part, because I'm guessing that sometime around mid-June, we're going to get some relaxations on quarantine. Do you think that I'm crazy to guess that? Okay, so let's say that I'm right. And if I'm wrong, I don't think I'm too far wrong. Okay, perfect, Steve, I like it, yes. So mid-June is when we're gonna hit the toughest topics. And not just the toughest topics that you see here, but the toughest topics for the whole course. Okay. Yeah, always, Phyllis. So I showed that just before the lunch break, Phyllis. But yep, so the last class's slides are posted already. You could go and grab them and print them off and follow from them. And I usually, this morning I didn't follow too closely because I wasn't that concerned about it, because I wanted to spend a little more time on the path to certification, which is a bigger deal today than it's ever been. Yeah, it's true, Mark. And I'm going to show after class always, or at the end of class every day, I'll always show you which quizzes and homework need to be done. Okay, and if I don't, Mark, you just remind me. And yeah, that way there's no sort of guessing. Yeah, and that's all it had to be, Nicole. Really, the quiz this morning, in fact, I opened it up in the morning session, right? The quiz this morning is really designed just to get you used to doing the quizzes. It's not supposed to be particularly difficult, but it is designed to kind of get you used to doing the quizzes. Although it is possible to fail it. I don't want to suggest that you're some sort of dummy if you fail that thing. It's the questions are still realistic questions. Okay. So I want everybody to start practicing saying to their spouse and or children, no, I can't go to the lake and or cottage with you today. I have tax to learn about. That's good. We're going to spend the next month and a half practicing that. Okay. All right. Okay, so what is economics? What are we looking at here? Well, this is where we start our breakdown right away here. There's nothing even easy about defining what is economics. And some people say it's the study of supply and demand. Some people will say it's the study of the means of production. Some people will say it's about optimization of resources. Okay, there's a whole bunch of different ways that we can look at it. In the end, we're generally going to come to the same idea that somewhere along the way, we're looking at a bunch of inputs, and our inputs will be things like, well, labor and resources. And then we're going to have outputs, and that's going to be material and services. And somewhere in here, economics is about understanding the relationship between those two things. Now, much of what we learn here in this course draws heavily on Adam Smith's Wealth of Nations, which is generally considered the foundational book for sort of Western economic thought. And this is really where we see this concept of supply and demand, and we see these concepts of um, fiscal and monetary policy really originate anyways. And that's fine, but there are alternate thoughts. And obviously the biggest one that we run into today is Karl Marx. And Karl Marx really took more a view of means of production here in his economic theory and tied a lot of class structure related thinking to his thought, to his theory. So anyways, this is where we do get this, these varying opinions about even what we're studying when we're studying economics. However, sorry, getting my train of thought here. I apologize. I completely lost my train of thought. What I want to point out, yeah, that's exactly it. Oh, you might have missed that, Andrew. I feel like that's almost exactly what I said. And I think you might have been, no, it's fine. I'm really glad you asked that. It just reinforces yes, I feel like that's a paraphrase of what we talked about, probably just what you were sliding back in from lunch. Yeah. So yes, exactly right. And I don't mind, I'm not trying to chastise you for asking a question, Andrew, just to be perfectly clear, okay? I only say I mentioned it because I think it's ironic that you present that understanding. Yeah, hey, perfect. I get that. I don't mind, thanks, Grant. I don't mind repeating myself, okay? And it's not going to be necessary too much here in chapter 2, but by the time we get into chapter 4, people are going to be routinely asking me to repeat myself, okay? No problem. I never want somebody to feel stupid asking a question. Okay, good. So yeah, if I say things like that, sometimes it's not meant to say I don't want you to ask a question like that again. Okay, just to be perfectly clear. All right. Oh, that's the worst, eh? Okay. So the sort of 150 years. Now, this doesn't actually hold true if you read the book, but if we take about 150 years of interpretation of Adam Smith, what we generally see is sort of a hard science approach to this. That economics, in roughly the first 150 years after The Wealth of Nations is published, economics takes a hard science approach where it basically teaches that we can solve any economic problem with a formula. And it's a sort of addictive idea, right? This idea that we can explain the world through math. Now, he was British. Oh, sorry, Scottish. Scottish. So Scottish, right? I'm 99% sure he's Scottish. Okay. Anyways, I should remember that. Sorry. If somebody can correct me, that's great. So now, if you actually read Wealth of Nations, he doesn't say that. He spends really like the first half of the book talking about human behavior. But what ends up happening in a lot of econ that we see practiced during this period is people are basically rewarded within the field for just coming up with better mathematical models. And this is where you sometimes hear the concept of Homo economicus, which I can't spell apparently. And this is sort of this, thank you, Stephen. All right, perfect. My memory was okay there. Okay, appreciate it, Bev. Thanks. Okay, so and the idea with Homo economicus is that this is a rational being who makes self-interested, rational decisions. And this is often the underlying assumption with any economic model or with many economic models. Now, you tell me, you all deal with people day in and day out. You watch them make financial decisions. Are those decisions normally, or maybe even most of the time, or what proportion of the time are those decisions rational? If we leave people to their own devices to make financial decisions, are they going to optimize for the greatest value? Yeah, there's a ton of emotion here, and a lot of it is unrealized. Okay, and we know this. Today we know that people are more swayed by emotion than they are by numbers they see on a chart or anything like that. Okay, and that's not universally true. We have to be real careful with broad generalizations here. Okay, yeah, it's fair. Any cultural influence like that, Mark, what I read on Facebook or what I Googled, absolutely, those things are important motivators in how somebody makes a decision. So even what we look at here for the next little while is all going to be based on this sort of Homo economicus decision or Homo economicus model. Yeah, and Grant, we're going to see in chapter 16 a ton of work being done, really fascinating work around that that emotional relationship with money. Okay, Brad Klontz and his money scripts work. Yeah, you really are. That's like 3 or 4 times now, I think, Grant, you made a comment that gets us further along. So, but I like it. I like adding that stuff to the course. It's much better, I think, um, for teaching some of that stuff now. So the nice, Andrew. I did lose track of the number of 15-year careers Grant has had this morning. I felt like we might have a. What's that guy's name? The long-lived guy from the Bible. I've lost his name. Malthusas. All right. So, okay. So the. Oh, sorry, that should not be Homo economicus. That's Homo economicus. Sorry about that. So I know some of you know this, but we do find some of this flipped on its head. So when we look at, and of course, the two people that get the most credit for this, rightly so, are in the late 60s. We get to, they're not even economists, actually. They're both psychologists, but we get Dan Kahneman and Amos Tversky. And they do this groundbreaking work in behaviors. Methuselah, thank you, Steve. You can put that on public chat. Methuselah, I just couldn't remember his name. That's what I was looking for. All right. So the, perfect. All right. So Kahneman and Tversky, they show that people don't make decisions. Okay, or at least they don't weigh risk and reward equally. And maybe it is rational. We're actually re-examining this, whether it actually is rational in a way. Thanks, Grant. Yeah. So, or maybe rational, but not optimized. There's a bunch of different models here. And this ends up really setting the world of economics on its head. So this is where we get the field of behavioral economics, which leads to behavioral finance. And I know some of you know these concepts very well. But I just want to acknowledge here that I do think today economics has done a good job or gets better at sort of marrying up behavior with math. Okay. And yeah, we're going to talk about Kahneman Tversky again in chapter 10 and again in chapter 16. I think that anybody who's dealing with people making financial decisions should have at least a broad awareness of the work of Kahneman Tversky. So we'll get there though. All right. Okay, so at the heart of most economic models is the question of supply and demand. And you'll see these two tools used pretty much universally. We have on the left side here, sorry, we see that as the quantity, sorry, I apologize. We see that as the price of something increases, the quantity supplied will increase. So this is our supply curve. And on the right side here, we see that as the price for something drops, the quantity demanded will increase. So we have our supply curve and our demand curve. And there's tons of examples of this. It's pretty easy to see. I know not everybody on the call is, I think everybody is actually insurance licensed, but we can look at something like that. So those of you that sell a fair bit of insurance, you sell more term policies just by app count or more permanent policies. You do a lot of insurance work. If you do a small number of insurance policies a year, it's probably different. But for most people, especially younger folks in the business, it's going to be more term than permanent, right? And this makes a ton of sense. This is exactly a supply and demand issue. That because the price for a term insurance policy is lower than the price for a permanent insurance policy, we're typically selling fewer permanent policies and getting more revenue for them. Now, that's the demand curve. And that really represents the buyer's perspective. So we can think of that from the buyer's perspective. And there's always something that breaks this model. It's not a perfect model, but if we take the sort of typical buyer, that's what they're going to do, right? Okay. Yeah, and it's useful, Andrew. It's one that everybody on the call can identify with. I don't think most people have thought about it with that particular product line, but I do think it's useful. Okay. On the supply curve, though, now let's assume a little bit of a mercenary perspective. Okay. So I have two clients, and let's assume that this whole pandemic thing is over. Okay. So I mean, that's a true story, Grant. I totally get that. But that's up to you to sell that value, isn't it? And left to their own devices, people are going to demand the cheapest thing, aren't they? Okay. I say left to their own devices, Grant. And that's what I said, not universally, but yeah, that's sometimes true too. If they have limited knowledge, see, this is where these models start to break down, because you're exactly right, Grant. If you're not fully informed, if I don't have an informed consumer, then we can't necessarily make these assumptions. Okay. So yeah, absolutely. I agree with that. Okay. So let's look at the supply curve. Nice. So the supply curve think about yourself now. Let's assume the pandemic is over. Okay. And you have two calls from clients. Okay. Both of them have asked you to come out and do an app. Both of them are ready to do an app. The calls come in within 5 minutes of each other. Both clients leave a voicemail. You're good? The clients are an hour in the other direction from each other. You're only going to have time to go see one of them today. One of them wants to put in a permanent app, and one of them wants to put in a term app. You like both of them equally. They're both equally favorite clients. Which one are you going to go see? Okay. Yeah, you've already talked to them, Gemma. You know what they're doing here. Okay. I like Ryan here. Ryan's going to zip around the country here. Okay. So let's go with that assumption. Thanks for the people that are helping me out here. So the both are, well, and that's kind of what I'm assuming here, Kevin. Do you see that? Both are equally needing of the insurance. Okay. But as the producer or the supplier, you're going to go where that permanent insurance is needed first. And I know that's maybe a little unfair, but let's go with that. So that's where it's the opposite, isn't it now, Steve? Now you're going to go to where the lower demand is, but you're going to supply more of that product. Okay. I'm assuming you've done all that work already, Grant. You've already, as you said earlier, you never sell something on the first meeting, right? So this is a follow-up to a second meeting or a follow-up to a first meeting or whatever. Okay. So the permanent insurance is the one that's going to draw more people out. That's what's going to create a larger supply. Okay? And that's what we see when we look at this from the producer or supplier's perspective. We get that supply curve driving up. And you can look at the automotive industry today as a great example of this. Every car manufacturer, except we could maybe isolate Tesla out here, but every manufacturer today has tons of sport ute and crossover products, and we see fewer and fewer sedans, right? Is that a fair comment? This is a well-documented trend in the industry. This drive to larger vehicles, which are higher price tag vehicles, and that's where the producers find it worth their while to make more of those larger vehicles. Okay. Now, what's supposed to happen in a properly functioning economic model, and this is really at the heart of capitalism. This is the idea with a properly functioning capitalist system, is that we're going to take these two curves and we're going to overlay them onto one another. So I'll take my supply curve and I'll take my demand curve. Okay. And where the two meet is what we refer to as market equilibrium. And at that point of market equilibrium, this is where supply and demand exactly match up. This is what we call an efficient market. Okay, so that's exactly it, Paul. When we look at something like oil with this weird, now it's not really like I can't actually buy a barrel of oil for negative money, but if I have a contract to deliver oil in, what is it now, 23 days or whatever the next contracts are due, then that contract has a negative value, right? So, but it's a weird thing, right? Where we see oil, and this is a reality too, Paul, is that sometimes we see commodities don't necessarily match up to this supply and demand curve nicely because there are many outlying factors. Okay, so, okay. Oh, I don't know that term here, Andrew. You have to educate me. Sorry. I don't have an econ background, Andrew. So I don't know if you can help out. Oh, have I? Can people just let? It looks like I'm still talking. Can people just let Gemmo know you can still hear me? Yeah, perfect. Okay, thanks. No, I wasn't. I thought you were amplifying the concept, Andrew. That's where I was going. Okay, so thanks. Okay, so Gemmo should be able to get that sorted out, I hope. All right, okay, good stuff. And that's what I'll do, by the way, when somebody comes on and says, I can't hear you, I'll ask a bunch of people to say, can you hear me? And then see, it's easier for Gemmo to troubleshoot the problem. Okay, so the idea here is then we have an efficient market. Oh no, Roxanne keeps getting kicked out. Okay, and this is what we see in a properly functioning capitalist system. Okay, is that consumers will help suppliers to properly produce the right amount of everything at the right price, and then we're going to have that perfect interplay. Now, the fact is that doesn't happen very often. Usually there's some drag or inefficiency on the market. Generally speaking, the more liquid a market is and the more responsive it is, the more efficient it is. So a lot of people will point to, and there's a whole world of theory around this actually, but a lot of people will point to the stock market. So the market for shares in publicly traded companies as an example of an efficient market. Now, we can argue about the degree of efficiency, and I expect that we probably will a little bit in chapter 10, but to some extent, most economists would support the idea that the stock market is as efficient as we're going to get in a sort of regular system. Okay. Usually, we don't get true efficiency. So if I live in Edmonton, for example, I don't have a direct line on the producer of most things that I buy. So we're not going to get immediate price responsiveness. We're going to have some lag between when I buy something and how that shows up to the original producer. Okay, that's fair. We could argue that some auctions are efficient. You hear that argument sometimes, but whichever, it's not something we need to get too hung up on. Now, I will point out that we sometimes don't do this. There are some tools that we use that generate some inefficiency, and sometimes this is quite deliberate. So who has farming and or fishing background? Farmers and or fishers? Good stuff, Ryan. Nicole, perfect. I know there's some fishers out there too, or at least people who have that connection to fishing. Okay, so with farming, can I produce an unlimited quantity of whatever I want to produce? So if I want to farm chickens, for example, no, I can't, right? I'm restricted there. So by default, we have something of an inefficient market. We see the same with fishing, that where we have mechanisms like rights and quotas, these restrict producers from being able to react perfectly. And the idea here, whether we buy this or not, is that by introducing this sort of short-term inefficiency, we're going to create better long-term effects. And that's often the trade-off here. Yeah, so taxes are generally, and well, it depends. Do you mean the tax that I pay to buy something, like a consumption tax, Paul? So I know how loaded a topic that is. I want to avoid election topics for sure. Yeah. Yes, I think that's correct, Paul. Now, I'm no economist, so if somebody has a different answer for that, but um, my assumption here, there we go again, is that we would include direct taxes like GST in your cost. I think we should. It certainly does dictate. And certainly governments can increase supply for something by changing taxes. In fact, we saw an example of that yesterday. I don't know, did anybody see this? Or sorry, increase demand for something by changing taxes. Yesterday, I think Department of Finance announced that they're allowing employers to pay up to $500 for an employee's sort of work from home suite. Yeah, I mean, smokes are a great example too, Andrew. Um, and what are we going to see? So, well, the problem with gas, though, oh, sorry, with tax. So the problem there, though, Paul, is that an Albertan isn't making a choice to go to Nova Scotia or go to Alberta to buy something, right? At least not most of the time, and especially not now. So this would be, I would suggest, a more relevant question if you're looking at somebody in, a border city, right? If you got somebody in a border city, that's where those questions do show up. Oh, I see. Yeah, that's fair. That could drive some, yeah. If you got a manufacturer who has sort of an equal opportunity to participate in either of those markets, they might choose to participate in the Alberta market. Although again, you have to keep in mind in Alberta, everybody is buying with that lower tax rate. Okay. Oh, Grant, don't tell us that. We're gonna. Remember, I said I have to turn students in. No, I don't. All right. Nice. Okay. So yeah. So what we're doing with these rights and quotas, we're trading a short-term inefficiency for some long-term outcome. So it might be keeping that industry whole. It might be concessions from another country on the trade front, whatever it is. And yes, I don't want to get into too much of a supply chain discussion. I don't want to Maxime Bernier myself here. All right. Any questions there? Okay, perfect. Okay, probably of all the things we're going to see, either this slide or the next slide are the most likely to show up in any sort of direct sense on an exam, and even then, a very low likelihood. Okay, so I wouldn't spend a ton of time memorizing this. I just kind of get a feel for what happens. The I don't know, nice thing, I don't know if that's the right word, but um, we're living one of these cycles right now. We're really going through one of these pretty hardcore as we speak, and it does, I think, help to understand how some of this works. So we're going to look at a peak in this cycle. Then we're going to have a period of contraction. And then we're going to have a valley, okay? Or we can point to a bust, and I should have said peak, I should throw a boom in here as well. Okay, and then we're going to have our recovery. And there will come a point, it's really not typically easy to distinguish from recovery, but, oh, I have no idea, Paul. I know where I hope we are, but this is such a dangerous guessing game. Expansion and peak or boom. I can think of at least 100 things I would have a better chance of guessing at. All right. So the Well, I hope we are, Cam. I hope that's true. Okay. So we look at these words, recession and depression. Okay. So recession is 2 consecutive periods of negative growth. And depression is not so well defined. Depression is really just an extended period of recession. Okay. So we definitely have this cyclical nature. Now, here's the problem. And I know some of you know this. So imagine that I'm operating a business, which isn't too hard because I'm operating a business. Okay. And I'm dealing with this sort of up and down. So how do consumers behave in a peak or a boom? What am I going to see from my clients here? If we're in a peak or boom, what's my client behaviors that I would expect? Yeah, they're free to spend, right? There's going to be spending behaviors here. Okay, there's going to be some greed here. That's true. Okay, so often the case that greed ties to investing, right? Okay, well, maybe people should be concerned. I don't know if they are, Paul. I don't know. Is that fair? We're going to have high employment. Okay, it's the time to invest, isn't it? Well, the markets are doing great. Oh, I don't think I have that right. What else do we see? What would be some of the other sort of characteristics of this sort of high point in the economy? What about inflation? What's happening with inflation up here? It's true, Andrew. We're typically going to see high stock prices. Okay, it's kind of true, Stephen, right? Life kind of takes care of itself. So yeah, it's fair, Mark. We're going to have mismatched risk tolerances. I would agree with that. Okay. So rates might be going down, but inflation, and I don't want to get into rates here, but so inflation and a real estate boom is a great example of this. Wage growth is a great example of this. We're going to see inflation in here. Okay. And yeah, wages, real estate, those are really good examples. Okay. It could be, Nicole, that inflation is increasing faster than wanted. We've seen a little bit of that well, not that recently now, but yeah, that's fair. And sorry, Nicole, did you not spend, where are you physically located, Nicole? I can't remember. So we'll talk about government spending on the next slide, Paul. I want to leave that for now. I know I should remember that, Nicole. I'm sorry. There we go. Yeah, I know where Breton is, so but you're helping everybody else out. All right, so yeah, I know the couple of people that said they had spent time in Peace Country or in Fort McMurray, and then more recently in Toronto and Vancouver, we've seen these examples of runaway inflation and how this has sort of negative effects. Okay, on the other side, if I'm in a recession, how do my customers behave here? Okay, that's what I was thinking, Nicole. I was sure that you had a connection there. All right. So what do we see from our customers in, okay, so here they're going to be cautious, which means a couple of different things. It means typically that there's low spending. And we've already seen these articles, right? You see this news showing up already. People using their credit cards to a much, much lower rate than they ever have. We see that the Discover card has released its first ever quarterly loss in its entire history in this quarter. Things like that would be representative of that low spending behavior. And that's a perfect trade-off. Roxanne exactly points to what we should be thinking about here is saving. And I'm just going to take a second to distinguish these terms for this purpose. So when we talk about investing, that's going to be stocks, bonds, and I know bonds don't fit perfectly into here, but bear with me, ETFs, and mutual funds. Okay. And when we talk about saving, where are people putting their money when they are saving? So this is now we're going to use bank products, right? GICs and savings accounts. Maybe money market. Okay. Yeah, we know this, Andrew, right? This is the time when stocks are returned to their rightful owners. Okay. Yeah, that's it, Todd, right? Might be literally. I bet you would find some people who are storing up more cash, literal cash today. Okay.
In
Okay.
Switzerland, people have safes in their floors now because it costs money to keep the money in the bank. So they are burying all the money in the bottom of their homes in vaults.
Just like Beth suggests here. That's yeah, with negative rates, that's it, right? Yeah, gold and silver, Mike, that's fair. Yeah. Yeah, that makes sense that store cash if it's going to cost you to put it in the bank. Okay. So we're going to see, just go back to our characteristics then. So we know, and this is good. Everybody's got a good grasp on this. It's easy because we're living it right now, right? Which is unfortunate. But what else do we see for behaviors here? What are some of the trade-offs against what we saw up top? We're going to see a lot of fear here. If I'm going to talk about greed up above, we're going to see a lot of fear here. Okay. Yeah, it might be TFSA. I don't want to get into TFSA and RSP. We'll deal with those later on. So let's park that. Yeah, perfect. Unemployment, 100%. Yeah, I would suggest panic is something of an extension of fear. Grant, those two things are pretty close, aren't they? So this is true. We're going to see low inflation or possibly other versions of inflation. We might even see disinflation or, in a worst case scenario, deflation. And we'll distinguish those terms a little bit later on. Unfortunately, Nicole, we're going to see some insolvencies here. It's yeah, and Todd, that would be a deflationary pressure, right? If home values drop, that's a perfect example of a deflationary pressure. Okay. I mean, Gemmo, there's some benefit to having a financial advisor, and one of those benefits is you get to blame your advisor for your bad decisions. Okay, we'll talk about that in chapter 16. Okay, you think I'm joking, but that's a true story. All right. Yeah, that's fair. I guess I don't want to put panic on the board here. Maybe I'm just hesitant to write panic on here at all. I don't want to set off a panic, Steve. Okay, so we see these two cycles. That's fair. These two cycles then. Now, as a business owner, if I wake up every day and it's an uncertainty as to where we are, and it's why the question has come up a couple times already, where are we? We want to know where we are in this cycle. So as a business owner, or really anybody who's just trying to make a go of it, but I think it's easiest to see for a business owner. I don't want to get up one day and not be sure if my prices are going to be 10% higher or 5% lower. Very difficult to plan my life like that. My ideal circumstance here would be that when I get up in the morning, I know that I'm going to have 2% more clients than I had this time last year. And those 2% more clients are each willing to spend 2% more on whatever I sell. And I'm going to pay my staff 2% more for the work they do. And I'm going to pay my suppliers 2% more for whatever they supply to me. If that's the situation, can I plan my business now without having to worry about all that uncertainty? This would be a dream, wouldn't it, to be able to take all that uncertainty out? And this is what we see then in response to that sort of desire for stability. And it's not just business owners, it's individuals and governments, households, whatever else that are going to have that same set of desires. So what we have seen, especially over the last, I would say about 40 years, is a real concerted effort to remove some of that uncertainty. And that's a problem, isn't it? When we see that 10% inflation and 21% interest, makes it very difficult, especially when it's 10% inflation one day and 15% inflation the next and 4% inflation the next. If only, Steve, right? So that's a tough time. And so what we really saw through really following the 1987 stock market crash was much more concerted effort to take these highs and lows out. Now, whether that worked or not, I mean, we can ask that question, but we've really tried to create this, what we sometimes call target growth. Or a target rate of inflation. And it's very much as I described. We see our target rate of inflation lately has typically hovered somewhere around maybe 1% to about 2.5%, depending on the year. And what happens then is we have our government and central banks working to create that steady, predictable inflation. Okay, does that make sense? Okay. Again, Andrew, so dangerous to guess at this. I've certainly seen people speculating about high inflation, which some people would argue is the same as devaluing currency, right? So I don't know. We'll talk about inflation in a few minutes, and I really am not qualified to guess at this. I have no idea. Okay. Yeah, I don't know. You know, people joke about this, right? So people will say, you know, you get 50 economists in the room and ask them that question, you're going to get 50 different answers. Okay? And that's sort of the unfortunate truth of it, right? Roxanne must be having internet troubles. Okay. I think if we just look at the base sort of concept, yes, that should create inflation, and that by extension means some devaluation of currency, but who knows? The last, and I would suggest really the last decade has been an experiment in sort of how far we can go with breaking some of these historical models. Okay. Yeah, exactly, Bonnie, where we just have money being poured into the economy. Okay. It's quantitative easing is the fancy word for that. Instead of saying printing money, we say quantitative easing. Yeah, I don't know what's going on there, Roxanne. Do you have all your background stuff closed out, Roxanne? Outlook is closed, Gmail closed, all that kind of stuff. You're not running watching kids play video games on Twitch in the background. Okay. Yeah, it's true. Mark might be right here. If you can put your cable on it, it might work. Yeah, that can create a more stable connection. Okay. So in order to, yeah, that's true too, Paul. Sometimes it's just the waves. Yeah. Although the cable would take care of that too. So the tools we see here that governments use to try and create that target rate of inflation. Okay. So we see both monetary policy and fiscal policy. So monetary policy, who is responsible for implementing monetary policy. So this is Bank of Canada. That's exactly right. Or whatever central bank we happen to be in, or in the country we happen to be in. So perfect, Robert. So Bank of Canada is the answer in Canada, but we could talk about others. So we can talk about the US Fed, the Federal Reserve, or the Exchequer, or whatever the case is. So every country, almost every country, has a central bank that takes care of its monetary policy. Okay. And then who takes care of fiscal policy? Okay, I'm glad nobody answered the question the way that I was fearful of getting answered. Okay, so fiscal policy, this is taken care of by our elected government. And mostly in Canada, this falls under the purview of Department of Finance. But there are other departments involved. It's not just Department of Finance, but finance is a big part of fiscal policy. The idea here is that they are supposed to be, provincial governments can do this as well, although provincial governments typically have fewer levers to pull than federal governments do, but yeah, it's a fair point. So I don't know. I don't know if I would agree with only taxation. I'll show you, because there's one big one I think shows up here too. And then depends on the industry for the others. So let's look at monetary policy first. So we've already talked about one of the monetary policy tools. There are really three big sets of monetary policy tools. What do we have here? How do central banks implement monetary policy? Okay, so we can manipulate interest rates. And we're going to talk about interest rates as a specific topic in a couple slides here. The money supply, which we already have chatted about. So how many dollars are in circulation? We're also going to talk about that in a few slides. So we can't do consumption here, although the idea is these things are going to influence consumption. What's our other? Perfect. So the supply of government securities. Okay, and that will be money market, treasury bills and government bonds. Those are all monetary policy tools. Okay, so and those things should all work together to either create or reduce consumption or create or reduce inflation, whatever it is. Now, one of the problems we see here, and you'll see this on the Bank of Canada website, the Bank of Canada actually has a pretty good website. And it has a lot of backgrounder information on it, explains how a lot of concepts work. Really, actually, a neat place to just spend some time surfing around. Okay, I know everybody after class will take me up on that. The problem here is that it takes somewhere between 6 to 24 months for any measure to take effect. And this is sort of the acknowledged issue. Now we're in this sort of emergency situation right now, so we do have an attempt to create faster outcomes. But even then, it's not directly what we see. So we know there's been a giant increase in the money supply, right? That the government of Canada has put tons more dollars in circulation. But that's not all that they did. So that first $50 billion injection of capital went right to the banks, who were then expected to use that injection of capital to create the mortgage deferral program. Without the mortgage deferral program, adding all that money into circulation would take a much longer time to take effect. Is that a fair comment? Are we okay there? And I'm not commenting on the merits or detractions from the mortgage deferral program. That's not my point, but only to show that if we strictly relied on monetary policy this way, it would have taken a much longer time for that capital flowing through the banks to end up in consumers' hands. Okay, then we look at fiscal policy. So what are our fiscal policy tools? What can the government do? And this is both federal and provincial. Okay, so perfect. That's all three of them bundled together here, Steve. So we have the power of taxation. And the idea here is that if we want more economic activity, we reduce taxes, which kind of ties into, excuse me, Paul, was it your question earlier about Alberta sales tax versus Nova Scotia sales tax? Okay, so we presume that with less tax, people will spend more. Then absolutely, government spending. And it does, yeah. So the Bank of Canada is the one who actually handles, it's called their large value transfer system, Paul. We're going to talk about that a little bit later on. But yeah, the Bank of Canada actually gets the dollars that the government commits into the bank's hands. The federal government does not have any other mechanism to get money into the banks. Okay, so yeah, the Bank of Canada does play a key role in all of that kind of stuff. And that's where we definitely have a little bit of overlap today between monetary and fiscal policy. So yeah, we saw tons of government spending. I don't know if folks remember this or not, but in the 2008 credit crisis, anybody remember this, where we had Canada's Economic Action Plan? So I live in a riding that was at the time blue, still is blue actually. And we had those signs all over the place. Okay, so yeah, and there was also other incentives, Nicole, but just the government spending, the number of highway projects, and I think that was good. I was a big fan of Jim Flaherty. I thought he did a really good job with that, and that was a response to that downturn. And it makes sense for the government to spend money at this time. They shore up economic activity. They're buying things on sale. It's really, I think, good fiscal policy to do this. Yeah, so those housing grants, I would actually suggest fit more into tax policy. And you're right, there's some of that. Yes, we're going to hear that language again, aren't we? Shovel-ready projects. Okay, yeah, absolutely. That's going to show up right away here. Okay. And our third is regulation. Now this can tie into grants as well. So if I want to increase economic activity, I can reduce regulation. If I want to slow economic activity, then I can increase regulation. Okay. Now, do these things work or not? I don't know, but we often see just 1 second, sorry. Okay. Yeah, so now actually, Andrew, the Americans get a hard time, don't they? They get a ton of grief around these issues. But what we've actually seen since 2008 is the Americans are saving at a higher rate than any other large country in the world. So they've actually, to a surprising extent, learned their lesson. But yeah, Americans are saving today at about 2.5% the rate of Canadians. So Canadian household savings is around 2% of income on average across all households, and American household savings about 5%. So yeah, they've backed off on that a little bit, but yeah, you sure see some questionable lending practices. Absolutely, you do. Okay, yeah, they had their great great deleveraging. Yeah, and that stuff still happens, but there's a lot less of it than it was. Yeah, absolutely. Okay. Any questions? Yeah, and I mean, we still see some of that in Canada too. It's naive to think that we don't have some of those same practices here, just not to the same extent. Okay. Yeah, and part of what happened there, so just, the subprime thing, ninja loans, all that, that was regulation, right? That was this slow relaxation of the regulatory practices around banks. And that drove a lot of economic activity from about 1996 to about 2008, right? Where we saw such a relaxing of regulations to keep that level economic growth happening. So it's, very much something that we see right here on this page. And the fact that there was very little regulation of a lot of that banking activity, it drove economic growth. So I know that in retrospect, those lending practices seem so awful, but at the time, they were what people wanted, right? It was what investors wanted. It's what governments wanted. It created that growth. Okay. Yeah, I mean, it's no good when it blows up, like any leverage, Andrew, right? Leverage is great when you're going up and awful when you're going down, right? Amplifies gains and amplifies losses. So same thing there. All right, let's have a look at inflation. We've used this word inflation a fair bit now. We should look at what inflation really is. Now, the first thing is, it's hard even to get agreement on what inflation means. This is another one of these Ask 50 Economists, Get 50 Different Answers questions. So inflation might be an increase in the cost of goods and services. That's one possible definition. That's right. Yeah, that's right. It might be an increase in the money supply. It might be a devaluation of money. Okay, somewhere in there we have what really is inflation. I think everybody's familiar with the concept, right? We know that if I go to buy whatever, I always like a can of soup. Can of soup is still a reasonably easy to understand concept, not can of spouse, can of soup. And maybe I pay $1 today for a can of soup, but I know the same can of soup, whatever, 5 years from now, and I don't know if this is right, but 5 years later, that same can of soup might be $2. Not literally the same can of soup. I'm not buying 5-year-old soup. Okay, although by then it's vintage, right? So yeah, it's maybe not the best investment. Okay, so this is what happens, Paul, right? Is just this. We look at the cost of goods like this. And this is the most common way of measuring inflation. If you're buying soup or eating soup at my house, I guess you better, eh? So this is our most common way of measuring inflation. What happens here in Canada anyways, is Statistics Canada has a basket of about 600 goods and services. Okay, and it's not a literal basket. Yeah, I mean, that's something people can easily relate to, Grant, right? Everybody who's been buying Timmy's for any amount of time knows that it's more expensive today than it was 5 years ago. So yes, I think you need something like that. Toilet paper is maybe not the best example today, but yes. Okay. So we have this basket of about 600 goods and services, and they shop for this. They sort of fill this basket 12 times per year in different regions. So they look at what it costs to buy this basket of goods in the Greater Toronto metropolitan area. They look at what it costs to buy this basket of goods in Eastern Saskatchewan. They look at what it costs to buy this basket of goods in Peace Country, and so on. Okay. Can't be, Grant. Seems impossible. Okay. So the idea here is they arrive then at an index. Now we'll look at this index in a little bit more detail, but index is a term we're going to see. That's true too, Ryan. All right. So they get an index. I'm not going anywhere, but I'm still going. I don't know. So get an index, and that's really just a representation. I think it's back on shelves in Alberta. I've seen it at Costco recently. So this is just a representation of the value of some underlying set of numbers. Okay, so it's a little bit artificial, but essentially what happens then, and there are some people who I know do not agree with how this is done, and that's fine. We're going to teach how it's done, and then we can look at some other considerations here. I like it, Steve. All right. So the idea here, in 2002, we set the all items CPI to 100. Okay. So in 2002, StatsCan said, okay, we're going to get a reset here. And they look at the basket. Now the basket changes. Okay. The basket changes every year as the real things that we buy change. So in 2002, when this index was reset last, we would have seen, for example, a Blockbuster rental on there. There would have, somewhere in that 600 items, there would have been, what's the cost of, and I'm not sure exactly what they did, what's the cost of renting one DVD, or what's the cost of renting 2 DVDs, or what's the cost of the typical number of DVDs that a family rents in a month. Okay, that's good. We all remember Blockbuster and DVDs. So today, you would not see Blockbuster in there anymore. What would be the substitute good that you would see in there? Yeah, that's exactly it. Trisha, you'd see your Netflix subscription. So that's where we would use, and it might be that they take Netflix and Disney Plus and Amazon Prime and average all those together. I don't know exactly, but they'll do something like that that represents what people are actually buying. I always used to say that if we were talking about this in 1985, we would have a pound of flour in there, but then, you know, most households stop buying flour in that large quantity, although now we're back buying flour. So then in 2020, and I'll look at what it is later on, I'll show you the actual amount, but it's something like 140, okay, or whatever, which means on average, these household goods and services, the things that a normal household needs, are 40%. Yeah, that's why I say normally I would use flour, Paul, but it's a bad example now, isn't it? Household goods and services are about 40% more expensive than they were in 2002. Now, there are some challenges with this because when we look at housing, for example, housing is often criticized as being poorly represented in CPI. Energy costs are another one. Okay, and especially energy costs are problematic because in part our utilities or our energy is not an inflationary expense or an inflationary good. It's related to instead, it's based on some underlying resource. So energy is always a weird one, and you do see a version of CPI that does not have energy included. So we can look at the all item CPI, or we can look at CPI that excludes energy costs. And there's a bunch of different versions of that. There's a bunch of different ways that CPI gets moved around to try and tell one story or another. Now, when we're actually looking to measure inflation, what we'll do here is we'll take the CPI, and I don't know the figures. I have a resource, I'll show you them later on, but I will take the CPI for, let's say, March of 2019. And let's say, for the sake of argument, it was I actually know what it was. We'll go 139.6. And then we'll take the CPI for March of 2020. Oh, thanks, Nicole. Oh, I don't, yeah, okay. I'm close enough, right? Is that March of 2019? Are you on the CPI or the StatsCan website? Sure, we'll go 134.2. And what is it for March of 2020? Do you see that number? I actually don't even remember if March's is out yet. It's probably not released yet, actually. So let's say for the sake of argument, it was 135.6, just whatever. That's how this works. I don't really care if I have the exact numbers. I will show you the numbers later on. So what we do here to measure change, and this is a common skill. You're gonna have to do this a fair bit. You don't need your financial calculator for this. Any calculator will do, including your cell phone calculator. All you do is take last year's value. Sorry, I apologize. Take this year's value minus last year's value divided by last year. Okay, so just take those numbers, or you can, I don't want to teach it, but you can use, there's a differential button on some calculators. It looks like a little triangle, a delta. You can use that to do the same thing. Anyways, that would be 135.6 minus 134.2 divided by 135.6. Sorry, divided by 134.2, I apologize. And that's going to tell us what the consumer price index is, or the CPI change. And that's the primary determinant of inflation. Okay, do I need any decimals in there, Robert? Should generally be doing at least one decimal. If it's just 1.0, that's fine. 1.04, I'll throw that in there just so we see how this works, but that's a 1.04% change year over year. Okay, that's all good. Okay. Now, there are other tools that get used to measure inflation, and we're going to see some of these throughout the course. So CPI is generally what we see in sort of a household situation. And one of the nice things about CPI is we do have a bunch of different CPI versions. Okay, so consumer price index, and that's the one that's probably most relevant for your clients. In most circumstances, but there are other indicators. There are other inflation tools. We can use, for example, house price index, HPI. And HPI is typically a regional index. It's usually given on a regional basis of increases in shelter costs. And the nice thing with HPI is that you typically get a fair bit of breakdown here. So you can see what this is for a single family purchase. For a detached home, you can see what it is for a single family purchase for a semi-detached. So that's always a good question, Robert. And unfortunately, you'll often see somebody just say, inflation was this. And we don't know. If that person doesn't say based on CPI year over year, then I don't know if it's based on CPI or something else. And I'll show you the other one that is often used just in a second here. Okay. Because there is another measure of inflation that's very commonly used on a much larger scale. You'd have whatever, you'd have a condo unit, you'll have it on houses less than 500 and more than $500,000 of value. Okay, there's all kinds of different versions of this. This is publicly available information, so you can go pull this information. It's usually maintained by real estate boards, which always makes me a little bit suspicious. Okay, I think there's a little bit of conflict of interest there, but anyways, you can look at this for your particular region. See what housing price index is, and it's nice to have a look at. Like I said, I'm always a little suspicious of that data. It's a little bit of, I think, fox guarding the hen house sometimes there, but whatever. I don't want to unfairly pick on the real estate industry. Okay, then we look at the one that, Robert, you might also be asking about. I really have no way to know, and that's often the problem here, and that is the change in GDP. So gross domestic product. Okay, yes, both of these, in fact, Paul, they can be more than that, but HPI, yes, there's always annual figures for HPI. There's always rolling 12-month figures, and then you can see 5 and 10-year figures as well. We can look at an HPI report if you want. So yeah, exactly, Robert. So GDP, gross domestic product, this is really the total money spent in Canada. Okay, that's really what it is. There's two different ways to measure it. We can measure it by, there are some exclusions here to be fair, but it's almost the grand total of money spent in Canada. And we can measure it on one of two bases. We can measure it on an income basis, which is where we look at all money spent, or we can look at it on an expenses basis, which is all deductions from income. Okay, whichever. Now, I just want to point something out real quick here. We're going to revisit this in Chapter 7, but there's actually a role for our tax system here. We don't think about the tax system as anything other than a way to pay for stuff. But the fact is that most of the information that we use to calculate GDP comes from our income tax system. Okay, so GDP again, we would take last year's GDP, sorry, this year's GDP minus the last year's GDP, same thing, and we're going to divide them. And we just divide then, and we get the rate of growth or shrinkage in the gross domestic product. And we're going to look at some definite deflation here, I think. Okay, I know I said I wouldn't guess, but I think it's hard to imagine otherwise. Now that's not it. Just the math here, Andrew, or how we calculate it. Sorry, Andrew, I apologize. What do we come off mute and ask?
Sorry, Jason, just the gross GDP. I mean, I hear it all the time. I don't really have that big of an understanding of GDP, but gross domestic product minus total money spent in Canada.
Oh, no, sorry, it's not minus. That's, I apologize. That's super confusing.
Okay. But it says total, it's total, no, sorry, I meant equal to, or total money spent in Canada. Is that, so that's after tax money, like what consumers spend in Canada? Is that what we're saying?
Essentially, yes. Although it's actually, it's a good question about sort of how it's really measured. We actually tend to measure it based on what companies do. So when I talk about income basis, so when a consumer spends money, ultimately they're always spending money with a corporation, right?
Mm-hmm.
Whether, I mean, I might go buy something from my neighbor, but that's really a short-term, relatively minor transaction. In the end, it's when I take my money and spend it at whatever, business career college or at Amazon or whatever.
Buying something
That's
from,
the, yeah. So, and this is the, yeah, so there's a bunch of stuff, Steve, and black market is a good example. There's a bunch of stuff that doesn't necessarily show up cleanly in here. And there's a little discussion around childcare in the textbook. Childcare is a messy thing as far as GDP goes, because, you know, there's traditionally childcare was something that was taught not to increase economic growth. But today we recognize that it, you know, gives the opportunity for somebody to go to work. So it does have a contributing factor, but a lot of childcare isn't reported here. So you get these giant messes with GDP. But yes, that's what we're looking at. So if I take all of the money reported as income by Canadian companies on a monthly basis, then I get the income basis. If I take all of the money those companies spent, I get the expenses basis. Those two amounts should be the same. In theory, they should be the same.
But we're not talking with taxes. This is just, you know, I'd say companies, the revenue minus their expenses. Is that fair?
Or just revenue or just expenses is really a bet. So I know income is a confusing word here, because on a P&L, income means exactly what you're saying, revenue minus expenses. But here, the income basis really means the sum of all revenues other than investment activity.
I got you. Okay.
Yeah. Okay. See, these questions are why this is so, like, it's such a, I don't know. There's a way to measure it, and that's what we do, right?
We just hear gross domestic product all the time, and I do know, but I don't know. You know, it's kind of a gray area.
Well, it's still pretty gray, isn't it? Like that's
China.
Yeah, it's a challenge here. And actually, if you look at the history of GDP, okay, and who doesn't love the history of GDP, but the economist Schiller, I think, whatever, the economist who originally presented GDP as a valid measurement tool, for example, said that military spending should not be included in GDP. Okay. If you took that argument south, like that theory would have destroyed Reaganomics, right? So it's this weird thing where you get this, you know, hardcore sort of like economics driven president. But if you look at the underlying theory behind how so much of his success was measured, it's yeah. So I think it is murky. I think GDP, and the textbook talks about this, is an imperfect measure. Okay. But it's the best we've got. And I
I
guess,
don't mean to hold you up on this, Jason. I just
no,
thought
no,
there was maybe I guess it's not as clear as maybe I thought it might have been.
no, I wish. But I guess the idea here is it's like equally unclear every month, right? So we're sort of using the same questionable data every month. And if we just don't change our method, then we're okay. So government spending is a weird one, Paul. Government spending is included to an extent, but what's not included is transfer payments. So direct government spending, yes, if a government goes and builds a highway or builds a bridge or builds a hospital, that's all included. That's good? Okay. But transfer payments, and there are big picture transfer payments, money transferred from federal to provincial governments, those are not included. But exactly that, as Nicole says, social programs. So old age security, for example, is not included in GDP figures. Okay. That's good. It just gets clearer and clearer, doesn't it, with every bit of detail we learn? Okay. But it's true that OAS is not included in there. Okay. Okay. So, see, except that then you back it out. So then you back out the transfer payments. So yeah, there's some dangerous assumptions in there, aren't there? Okay. So it's just this, Andrew. It's designed to represent whether the economy is growing or shrinking. That's really it. Okay. So is the economy bigger than it was last year or smaller than it was last year? GDP is that measure. Yeah. Nice. There you go. Okay. As for the exam, I do want to just mention one thing before I get ahead of myself here. And this is around CPI. We'll go through a couple more concepts real quick, then we'll take a coffee break. So CPI is used for most indexed benefits. Okay. So when you have any sort of benefit program, it will always tell you what it refers to. For example, your OAS payments. OAS is indexed quarterly to CPI. Okay. Your CPP benefit payments are indexed annually to CPI. The guaranteed income supplement is also indexed quarterly to CPI. That's true, Paul. Yeah. When you look at, let's say, a cost of living adjustment on a disability policy, it's normally going to be something like, and I'm not saying this is always the case, but it's something like CPI to a max of 6% a year. If you have an indexed pension benefit, those are typically CPI or some version of it. And these are often provincial CPI. So if you're looking at a let's say HOOP, the healthcare workers, healthcare employees of Ontario Pension Plan, HOOP, it uses a best efforts indexing based on Ontario CPI. Okay. That's good. Okay. So you do get some regional differences here, and those can mean that your benefits aren't necessarily all changing on the same basis. Okay. So then we look at the year's maximum pensionable earnings. Now that, strictly speaking, is not an indexed figure. What it is, it's indexed, or it's based on the year's average industrial wage. Okay, so what happens here is StatsCan surveys 23 industries across Canada. They look at the full-time wage for an employee in that industry. We pool that all together and we get the average industrial wage, which then becomes the YMPE. So this is another measure of inflation. Where do we see YMPE used? No, sorry. Oh, I apologize. I totally cut you off there. Yeah, CPP, that's it. So this shows up in pension calculations. That's exactly right. Pension calculations often use this, and your CPP maximum benefit and maximum contribution as well. Okay. And sorry, I missed your question, Paul. The unemployment benefit, like employment insurance benefits, is that what you're asking about? Yeah, they are. They are. So they are larger this year than they were last year. Whatever they are, 576 a week this year. It was 551 a week last year. I can't remember, but it is, yeah, it is indexed. I believe it's based on CPI, but don't quote me on that. But I believe that EI is based on CPI. I just don't know that for sure. Okay. Whew. Good. Are we more confused than when we started? Probably means I'm doing it right. Okay. So I've got 33 minutes past. Let's take a 15-minute break. And we'll resume at, I'll talk about that after the break, Andrew. I'll talk briefly about that. We're going to go into that in tons of detail when we get into chapter 4. We'll resume at 48 minutes past. Okay, we'll see you back then. Thanks. Oh, I see, Steve. Now I get it. All right.